measures. Let's dig in to the energy sector with Kevin Book of Clearview Energy Partners and Kenny Polcari of Slatestone Wealth. Good to see both of you.
Hi.
Kevin, people are bearish now because they're worried about that demand destruction, slowing China, slowing Europe, slowing the U.S. And when the economy slows, it's a lot less oil consumption. Do you disagree?
No question about the demand fears, but against a backdrop of structural supply shortness in energy writ large, we may be overlooking what it means to be short about 1.25% of the energy the world consumes because of war and because of sanctions. Some of the gas cut off to Europe, that bleeds into barrels. Distillate on the grid, backup generation, that's some source of offset to the demand woes.
Kenny, I think you're going to agree because you're recommending a few of these names, including Exxon.
Yeah, I absolutely agree with him. I think it's absolutely right. And I think it's being, misunderstood. I also think the strength of the dollar has certainly helped put pressure on commodities, and oil as a commodity is certainly suffering that as well, right? So, but a rising dollar doesn't necessarily mean demand destruction across the energy space. And so you're right. Exxon Mobil would be a fan favorite. Anyone who's got energy in their portfolio or a long-term portfolio, Exxon Mobil should find kind of a place in there as a core holding, right? I mean, it's a big mega cap name. It has a 3.75%, I think, dividend is what it's paying. It's up 55% this year. And it's more than just oil, right? It's oil, it's exploration and production. It's gas, it's coal, it's minerals. And they are transitioning as well into renewable energy. So from a long-term perspective, I think ExxonMobil has to be a name in anyone's long-term portfolio that has energy names in it.
You mentioned gas briefly there. What is the gas play, Kenny? Because that's where a lot of the focus and attention and the need globally has shifted.
That's right. But you're talking about natural gas.
Which names? Yeah, natural gas here in the U.S.
Right. So natural gas. So Chesapeake is Chesapeake is another one. It's an oil and a natural gas play. Right, because there is going to be a demand, and that we see what's happening in Europe. That's going to be another disaster. But certainly in this country, you need to play natural gas. Another place we need to play. Chesapeake, that's up 62%. That's got a 9% dividend. That's a great stock to own. Another solid name in a portfolio that investors should consider if they're going to have energy in their portfolio.
I think we're going to go 3 for 3 on Bullish Energy, right, John Spallanzani? Yeah. You too?
Yes, I think that
not too consensus.
It's too early for renewables, and they really. I think the sweet spot right now, it continues to be 85 to like 125 with oil. Obviously, we're below that now. I think that demand destruction, recession fears, all the things that you mentioned at the top have pushed us down to this 80 level. I think 75 is kind of like a level to watch. But longer term, until we could take our iPhone and take it and power up our Teslas with it, fossil fuels are here to stay. And I think that's going to leave an underlying bid, not to mention it's a national security interest now. Now that we see what happened in Germany, they were getting all their gas and power. All of Europe was, obviously, from Russia. Now it's a national security industry, national security interest. And like some people said, I think Warren Buffett was one, that they don't even want us to export some of this natural gas, right? They want us to hold it in the United States as a source of security. Just in case, security.
Well, look what Putin just said. He's prepared to let the Europeans freeze this winter, as far as he's concerned, right? He's weaponized energy. He's weaponized natural gas and now oil, and so that becomes a national security issue.
Kevin, but you've been monitoring also some of the policy responses out of Europe. They're trying to cap energy bills. Price caps, I not such a great track record. What do you make of how Europe has dealt with it and where their power is going to come from?
Yeah, Sarah, the buy the commodity, not the company theme starts to show up when you look at Europe, particularly because price caps and windfall taxes tend to artificially distort markets in ways that leave supply short, but at peril of, unfortunately for some of the companies, putting them out of business or impairing the revenues. So when you look at Europe, particularly the questions that they're dealing with right now, can they put a cap on prices? Can they inframarginally cap the resources, the clean resources on the grid? All this stuff could be short-term. Short-term intervention comes and goes, but the long-term risk adjustment that investors make to what they look at in the numerator, the revenues received, or the denominator, the discount rate, all that means less going into the ground in the future. So in the near term, probably some risk to companies, but longer-term risk also to supply, and therefore bullish.
Kevin, Kenny, thank you both for joining me tonight.